Okay, two announcements before we head into this week's market outlook. Next Sunday at 6 p.m. When Globex opens, I'll be doing a live YouTube stream for the market outlook viewers that maybe want to ask me some questions on that. So that's next Sunday at 6. Next Monday will be the first video in the Portfolio Management and Construction series. So hopefully, if you're an Applied Series subscriber, you've already got your paper portfolio or the broker through which you'll use your paper portfolio set up. If you have interactive brokers, then when you log in, you just click on paper trading instead of live trading, and you'll have your paper portfolio. So we'll start next week by setting up our initial screens. We'll spend that time just determining, well, what information do we want to look at? That's the first video hits on the 17th, which is not tomorrow, because tomorrow is the 10th. The following Monday, the first one hits, and every Monday after that, there'll be a video up. I think I may at some point move that to a Sunday release, because once we start getting into the actual trades, it may make more sense to have it released on a Sunday as opposed to a Monday. It's just IT doesn't work on the weekends, so it's hard to get them to release something. But maybe if I have it posted on a Friday, I don't know, we'll figure that out. But that starts next Monday. If you don't have the Applied series, you can head over to markmeldrum.com and you click these three little buttons over here. Well, on mine, you have to click the three little buttons because of the size of my screen, and there it is, Applied Courses. This is the Applied Series bundle, which has everything in it. Or you can pay per module. We have it set up so that you can buy just the Portfolio Construction Management option on its own. And for a detailed course description, we have 3 PDFs, English, French, and Mandarin, because the employee I have speaks fluent all 3 languages. Isn't that convenient? So next Sunday, live session. Next Monday, we begin the Portfolio Construction and Management Seminar Series. We've got a lot to get through this week. Lots of activity in the bond market last week, and some equity market weakness as well. Let's have a look at what we have. Money market rates. All well behaved, all above the current range of 5 to 5.25. There is a belief that the July meeting is live for 25 basis points. So the 3-month, the 4-month, the 6-month are already reflecting that. Even the 2-month is reflecting that. This is interesting over here. Look at this for July 6th, a new cycle high on both the 6-month and the 1 year, taking out the last October levels. So where are we on the 2-year? 494 versus 505 on the cycle high. That was March 8th. We did get to, I think, 5.04 intraday on Thursday. But on a closing basis, no, we didn't take out the 505. We're 9 basis points below taking that out on the 3-year. We are 7 basis points away from taking that out. And on the 5-year, we'd be going back to October to take out those cycle highs. 10 basis points. The big one here to watch is the 10-year. We're at 4.06. October 24th was the peak at 4.25. We're 19 basis points away on the 10-year. And the deciding factor will be Wednesday, will be CPI. If CPI comes in hotter than expected, I expect next week we'll be talking about all the way to the 10-year being taken out in terms of the cycle highs. But if it comes in lower than expected, then there'll be more weight on a 0 basis point move in July, and I think all these will retreat. I did a lot of TLT and ZB plays. I'll explain that on the next screen coming up. Our curves are uninverting pretty aggressively. If you look at the 2 to the 10-year, 18 basis point uninversion or steepening during the week, and the 3-month to the 10-year is 22. We do know that curves tend to uninvert before recessions, but they usually uninvert by the short end dropping. This is going the other way. What we have is a steepening of the curve. We have a bear steepening because we have longer rates rising. But we're negative 88 on the 2 to the 10. That's 368 days now. Negative 140 on the 3 month to the 10 year. That's 255 days now. And even the forward, the 3 month rate 18 months from now minus the current 3 month is negative 123, was 134, negative 134 last week. Balance sheet continues to run off. The SOMA's run off by another 39 billion. That is now at 7.577 trillion. The full balance sheet down to 8.29 billion from 8.34, drop of 42.6 billion. The SOMA was 39 of that, so another net 3.6 billion came from something other than the quantitative easing securities that were purchased. The outflow from money markets has reversed. So we have money market fund assets increased 43.7 billion. Retail increased 17.25, institutional 26.45. Government funds on the retail side increased by 10 billion and by 18 billion on the institution side, and money market about 5 billion for retail, almost 6 billion for institutional. So that money that was heading out seems to be heading back in. And if we do look like we're going to get another rate hike, it's gonna, the money market is just an incredible draw right now at over 5.5%. It is difficult to start to compete with an equity market at a valuation that is priced for no landing, and a level of risk associated with that may not justify taking on the extra risk when you can get even in a 4 month, you're getting 5.5%, and you can step aside for the summer. Harder and harder to compete with that. What is going to be, I think, challenging is banks in terms of deposits. You are seeing outflows, right? Government going into government money market funds. Well, these outflows, those inflows have to be outflows from somewhere else. Are they from deposits? And we're coming up on earnings season. We'll get some big banks later in this week on Friday, but most of the regionals will be later. But I think a key metric to watch on the regionals is how much deposits are down, because deposits are a low-cost source of funding, and they have to replace that with a higher-cost source of funding. So regionals may face some issue because this is a magnet, right? That is going to draw funds. The July FOMC is now 17 days away. CPI 3 days, PPI 4 days. And for the Canadian watchers, Bank of Canada is 3 days from now. Lots of Fed speak next week. Monday you have Barr, Daly, Mester, Bostic. Tuesday is Bullard. Wednesday, Kashkari, Bostic, Mester. Thursday is Waller. And then Friday you have some major banks that are reporting. So Wednesday, big risk day. Thursday, kind of a risk day with PPI. We'll see what happens there. You have lots of Fed speak and earnings. Lots of things to be to keep you glued to the screen this week. 25 basis points now at 93%, almost a sure thing. 7% on zero. This sort of gives Fed permission to raise 25 because the market has already priced in a 93% probability of it, so they wouldn't be really moving anything other than just filling a hole that has been created. Bank of Canada, expectations there are 65%, and we get that in 3 days. I don't think they're going to go. On the last rate hike, I thought they would hike. The consensus was no, and they did hike. The consensus now is 25, and I'm on the other side. It seems like I'm always against the consensus for some reason. But I'm on the other side thinking I don't think they're going to hike. A key difference between Canada and the U.S. is Canadian households are far more interest rate sensitive because of the nature of the mortgage market. I don't know if there are any 30-year fixed. Most mortgages are term mortgages, meaning you'll have an amortization schedule of 25 years, but you might have a 5-year mortgage that's amortized over 25 years, which means after 5 years you renew for another 5-year term, which means you have to go back and sing for your supper. And those mortgages reset at the higher rate. So Canadians are far more interest rate sensitive and have significantly more household debt than Americans do. So I think the Bank of Canada has to be far more concerned about the effect on the household than the Federal Reserve is. So I think that Meldrum has a tough job here in that the pain that would be caused would be outsized pain compared to what would happen in the U.S. December, going to the end of the year, for a rate cut, almost non-existent, 0.5. It was 0.9 last week. Basically could just take that off. Look at the 6%. It was 1% last week. Now the weighting is at 4.6%. And the 5.5 and the 5.75 have both increased. So you've got better than, what are we looking at, 84% probability that we end the year with 1 to 2 rate hikes from where we are now. Fed's effective federal funds rate, 5.08. Look at the reverse repo. Now that we have June 30th out of the way, we're seeing the effect of new T-bill issuance and balance sheet runoff in the T-bill space as well. 1.822 trillion, a drop of 212 billion, and that's going out at 5.05%. Treasury general account has increased by 48 billion up to 513. That does not mean that only 48 billion was issued during the week. It means that of everything they spent and everything they brought in from both debt issuance and tax collection, they are net up 48.288 billion. And our lags, we have to be concerned about the effect of the lags. And when we read the minutes, we had a paragraph that said participants were wary about the lag effect, and that we really do have to consider these. And then several other participants said, no, there is no lag, given the lack of interest rate sensitivity in much of the economy. Whatever is working. And if you don't want inflation expectations to become embedded, you can't wait for the lags to show up. So if you, for the central bank participants, the FOMC participants, those that are advocating that there are no lags and that it works when it works, and if we're not seeing it work, we have to do more, they'd be more hawkish, and those that are advocating for letting the lags work would be more dovish, arguing that let's not be too eager to raise rates. But pick your lag, and this column here for effect is what still needs to be felt in the overall economy. So if you think, well, these things work with a 12-month lag, then there's 350 basis points of hiking that have been done, but the effect of those hikes have yet to be felt. So pick your lag. Okay, real rates, big moves here. July 6th, we hit a new cycle high on the 5-year real rate of 2.15. July 7th, Friday, a new cycle high on real yields on the 7-year, and this should be a 9. 1.79 is a cycle high on the 10-year. So late last week, the 5, the 7, and the 10-year real yields hit cycle highs. We are 3 basis points away from the 20-year hitting a cycle high, and we're taking out the October highs over here. On the 30-year, we're 4 basis points away on the real yield, and we have an inversion of negative 34 basis points from the 5 to the 10. Look at how big these moves are, 18, 19, 20, 18, 16. Those are big moves in real yields. And if the equity market is paying attention, that should be quite negative for REITs, especially for REITs because they have bond-like cash flows. But REITs hardly even budged. REITs are extremely mispriced, given where rates are, given where the level of growth is, given the concern in the commercial real estate market. REITs just appear to be very overvalued right now. Break-even rates didn't really budge that much. The longer-term inflation expectations appear to be well anchored, so I don't know that the Fed would be too concerned about that. But the longer the fight against inflation goes on, the higher those expectations will go, and that's not what they want. So if we had to pick a fight, would they err to the side of caution and raise rates or leave rates flat? I think that they would probably want to do more sooner so that expectations don't get embedded. But everything could change Wednesday morning at 8:30 when we get CPI. The core could show if it shows like a big drop, like 0.3% drop, we're off to the races. Bond yields will drop, bonds will rally, and equity markets will probably print new highs for the year. Every week seems to be the do or die week. Last week was all about jobs, and the market focused all of its volatility on those numbers. This week, I think the market will focus all of its volatility on Wednesday. We'll see what the Fed speakers have to say, but last week we got two messages, one saying, oh, we got to go higher, and another one saying, oh, I think we're good. I think we're good where we are. So there are divisions forming inside the Fed. If we look at Fed funds rate, not much movement. Still bottoming in November, an increase of 1.5 basis points on the implied rate. December sitting at 5.4 on the implied rate, an increase of 1.5 basis points, and going out to March, the implied rate is 5.285, which is an increase of 5 basis points from the week before. So this curve is slowly moving downwards. That if nothing breaks, I think the market is deciding that, the Fed's still probably not going to cut by March. Going into 2024, using the 1 month rate, 123 basis points a drop. December sitting at 416 of 2024 versus 539 for 2023. The implied rate on Fed funds futures is 5.4. 1 month SOFR is 5.39. You can see how very close that is. Negative 123. Last week was negative 114 though. So this is implying even more than we had last week. And I think what would be built into 2024 is not job done by the Fed and they're going to cut rates and bring us back down. I think what is more likely to be built into 2024 is you are going to break something and you're going to have to reduce rates. So I think 2024 is reflecting the Fed needing to lower rates, not wanting to lower rates. Let's look at TLT. It had an ugly week, down 3.75%, but now you have implied volatility on the 13-week, 39%. It was all zeros the week before. Now you have something. SPY pulled back only 1%. Really outperformed the bond market here. But I didn't sit still. August, I sold 101 puts at 196, 100 of those. I sold 100 puts at 204, 100 of those. Sold 99 puts at 204, 100 of those. As it kept dropping, I kept selling. I kept selling the puts because at this point, I do want a significant holding in the long bond, and TLT is a great way to get it. Also, ZB, the 123 put, I sold 10 of those. I got the 126s and the 123s at 2 and 31 over 64. These expire October. These puts expire in October with the December underlying. And some people have said, well, these are cash settled. What's the point of doing this? The way that you get the bond, because IB doesn't allow delivery of the bond, that means you can't get the bond. What I'm doing by selling a put at 123 is locking in a price of 123 less the 2 and 31.64. So if this is if it expires under 123 and it's cash settled, I would have a loss. I simply buy 123,000 of the non-on-the-run 30-year bond. So I can go in the Treasury feature in IB. I can find a 30-year off-the-run bond, Why off the run? It'll have a higher yield than the on the run, slightly higher yield than the on the run. So I'll buy a non-on the run 30-year bond. I'll buy 123,000 of it because that is the put price over here. And if the 126s get put, I buy 126,000 of those. So it's just, think about an FRA, a forward rate agreement. You know that when you enter into an FRA, it is cash settled. And then you go into the market and you do your deposit or your loan, your 3-month deposit or your 3-month loan. And the cash settlement offsets the cost or the income you would get in the cash market. It's the same thing here. The cash settlement will offset what I have to pay in the market. I'm basically just agreeing to pay 123,000 or buy 123,000 of the 30-year or 126,000 depending on which, if they're put to me. Mortgage rates 6.81, only 1 basis point. The 10-year increased by 20 basis points Thursday over Thursday, but the fixed rate mortgage only increased by 1. That drops the spread 19 basis points. Didn't help the mortgage REITs though. Agency down 3.65, Annaly down 3.9, ABR only down 0.94, IYR up 0.13. That is on Wednesday it was the right move. Thursday was the right move. Friday was the wrong move. And Digital Realty, data center REIT down 0.06. Basically call it unchanged. But this is curious that it continues to perform this way, and I think given where real rates are, it's overvalued. Housing, finally get a pullback in housing. DHI, Lennar, Pulte, Toll Brothers, KB Homes, and Hovnanian over 6%, almost pushing 7%. XHB and ITB both pulled back, but to be clear, DHI and Lennar have pulled back from 52-week highs. They haven't corrected from 52-week highs. They've only pulled back. Correction would be 10% off the 52-week high. They're not there yet. It would be nice to have some selling in that sector for a while. Now remember, S&P was down like, what was it, 1.1%? Since the home builders had outperformed so well all year. There is some, I think, excess profit taking in the home builders, which makes sense. Why wouldn't you? I already did. I took half my position off on those, and I stopped selling puts because I was getting uncomfortable with the speed at which they got to their valuations. So I'd like to see DHI pull back under 108, 107. I'd add there. We'll see if the market gives it to me. Mortgage apps for June 30th down 4.4%. Both refis and purchase are down. There is no housing data next week, so we can expect the housing sector to trade along with overall market sentiment. And I almost didn't mention it because it almost seems like a nothing anymore. If we look at OAS, how come I can't write on this screen? If we look at the OAS, all of them have decreased. Look at the triple C, down to 9.49, pulled back 30 basis points over the course of the week. Now this is to the end of Thursday, but Thursday was an ugly day, especially in the bond market, and nothing, just no fear. In fact, it seems like a flight to quality means buy high yield bonds. Look at that. This is the spread contracting in terms of percentages. There's high yield contract 4.65%. It's now high yield is the flight to quality, it seems. Let's take a quick look at the grains because you have a report Wednesday at noon, the WASDE report, which is World Agricultural Supply and Demand, which presents what they refer to as balance sheets for each of the grains. How much total supply there is, how much total demand, and their forecast for ending inventories. That's put out monthly, so we get that on Wednesday. The quarterly report for planting came out, and it was very bearish for corn, but very bullish for soybean, and for wheat it was kind of in the middle. Since then, corn has basically gone sideways, along with wheat, basically gone sideways. I had sold my puts on both wheat and on corn to engineer prices that would be below this particular line. My break even is below these particular lines, which to me is kind of a safe place to be. Soy has been giving back, which I find very curious given the forecast for the lower, I think the planting came in like 6% lower than what was expected. So these reports that are coming out, we can look at for wheat, it'll be on page 11. I'll show you the report from last month. Page 11 for wheat, page 12 for corn, page 15 for soy. And this is what it gives you, the area that's planted, and it gives you the projection 23-24. And the reason it says 23-24 is because of the seasons. We call them balance sheets. So think about a company's balance sheet. What's its fiscal year, right? Some companies are, January 1st to December 31st. Well, what's the fiscal year for wheat, corn, and soy? It's the planting and harvest cycle. So the marketing year for corn and soy is September 1st to August 31st. So when we say the 23-24 projection, it is September 23 to August 24. For wheat, it is June, I think I'm getting this right, June 1st to May 31st. So we're already in the 23 fiscal year for wheat, the harvest year. It gives you area planted, area harvested. These are projections, and then the yields per harvested acre. If you want prices to go upwards for all of these, you'd like to see those go down. Estimates of area planted going down, area harvested going down. And the big one here, if you can get area planted going down and yields per acre going down, that really lowers potential supply. You'll have supply total because you have your beginning stocks, you have production, and then you have imports will give you a total supply. From that, you have all your use. So here for wheat, you have food, you have seed, feed, and residual. There is domestic total. Then you have your exports, their total use, your ending stocks, and then from the ending stocks, they project out what they think the average price per bushel will be. So you'd want to see supply dropping and you'd want to see demand increasing. The combination of all of that is bullish for price. So if we get this report out, I'll show you what it looks like. You find the last column. And it'll give you the month, a month over month. So we'll have, this is the last month that we saw, and then you'll have the new month down here. And you can compare it side by side to see if something is increased or decreased. We would like to see total supply decrease and total demand increase if you are bullish or if you are looking for prices to go up. Let's have a look at the last report. All right, so here's the last one from June 9th, the World Agricultural Supply and Demand Estimates, and it has some narration up front. You have a table of contents. It tells you what page to go to, so we could see U.S. wheat supply and use, page 11. Let's just go there. This is grains, this is corn, oil seeds. There's wheat. So here were the May projections for 23-24. Here are the June projections. You can see area planted unchanged, area harvested unchanged, yields slightly higher, which is bearish for the price because that increases supply. So when we look at total supply, last month for May, it was 2,393 million bushels, and it increased to 2,399. That is purely the yield increasing. And we look at our total use, 1837, remained unchanged. So slight increase in supply, no change in demand, which did drop the estimated average price from $8 to $7.70 because of the extra increase in supply. So if we are hoping for an increase in the price of wheat, one of these three variables up top, area planted, area harvested, or yields per acre, we would have to see that drop because we want to get total supply to drop. And then, or alternatively, if you can get a total domestic demand, or sorry, total demand, including your exports, total demand to increase, that will do it as well. So this is the column that would be looking for, and we would be comparing it with the column, from the previous month. So when we get the report at noon on Wednesday, this will say June, this will say July, and then we can quickly go to the page we want, scan down, and we can tell. Well, the market will tell you much faster than you can look based on where the price direction goes, but you can at least bring it down to, the price is moving because of what? Is it because of supply or because of demand? Okay, lumber. I introduced this last week as something to look at week over week, up 1.6%. Here we are coming up the side here. U.S. timber REITs and Canadian timber companies pull back slightly last week. This down here is interesting. I like this little graphic. This is a picture of where all the fires are, and I'll draw the border, the Canadian border here. There's the Canadian border. All these little spots is where there happens to be a fire right now. Canada is on fire. I mean, look at that. Some of the headlines, if you search for Canadian wildfires, this is from Politico. Literally off the charts. Canada's fire season sets records and is far from over. From Associated Press, wildfires in Canada have broken records for area burned, evacuations, and costs. From The Guardian, Canada faces long, tough summer of wildfires with even hotter temperatures. And the subtext here, more than 9 million hectares of country had burned, federal data shows, shattering a 34-year record. And again, I've drawn the border here. Just look at all those fires and where they are, and it is only the beginning of July. We haven't even gotten into the dog days of summer, which is, once you get into August, end of August, if you have really hot weather, you have a lot of dry forest. So we are nowhere near out of the woods, pun intended. So lumber continues to reflect the fact that these things are burning. Now, this is the tricky part of this. Lumber prices are probably the cleanest way to play this, but lumber futures contracts don't have very good options, which means you have to play the contract itself. You can play the timber producers and the timber REITs. Problem is, what if their fields or their plantations are the ones that are on fire, right? So now you have idiosyncratic risk as well. So based on what I'm seeing here, where Canada is, and here's the U.S., I'd be more willing to play the U.S. timber REITs before I play the Canadian ones. Just on a visual. Okay, this is the CAD.yen. And I was short this pair, meaning that I was long the yen, short the Canadian, and it really had a great week last week. But I think it's not going to hold. One of the reasons for the yen strength was this report here, which came out on the Thursday at 7:30 p.m. This is earnings. 2.5% came in way stronger than expected. However, look at household spending, down 4%. The expectation was for only down 2.4. Yes, it is an improvement over the previous, but down 4%. Household spending. This is year over year. If you look month over month, negative 1.1. Well, if you don't have spending, you don't have inflation. You are getting wage inflation, which is good. And the belief was, well, that's going to start pushing the central bank to probably first relinquish yield curve control and start thinking about inflation being more important. I don't think so. I don't think that's going to do it. I think the market had it wrong there, but it wanted to give me a gain, so thank you. But I think the market has it wrong. And later into Friday, after the jobs report, there was more and more discussion about, well, this is going to force the Bank of Canada's hand. They're probably more likely to raise rates next week. And I looked at the outcome and I thought, no, I don't think so. Yeah, you had huge job growth, 59.9, but you had job losses previously. So if you take a the 2-month change versus the forecast, it's not that far off. Here's the good stuff, though. We had 5.2% unemployment. We have now 5.4%. And that's the participation rate here. 65.5 is now at 65.7. The participation rate is increasing. The unemployment rate is increasing. And even though average hourly hours is a messy number to look at, it's still looked at. 5.1 to 3.9. I mean, that's fairly significant. So I don't think the Bank of Canada is going to go next week. And I don't think Japan is going to do anything either, which puts me in a position of saying, well, I don't know what's going to happen. Because for this to continue on, I need to see continued yen strength and Canadian weakness. I think I'm going to get Canadian weakness. I don't think the Bank of Canada is going to go. So I think that's in there. However, I don't see off of this report from Japan that I'm going to get yen strength. I don't think that's going to move the Bank of Japan at all, which means that I think the next move more likely is a retracement back up to these levels here. So I had exited my position on Friday. After reflecting on it Friday afternoon, I thought, no, I don't agree with the consensus here again, so I'm going to step aside. Thank you for the 300 pip movement. Thank you. But I think both sides are wrong. I think Canadian strength is wrong, and I think Japanese strength is wrong as well. So I'm going to step aside and hopefully try to re-enter in the low 109s. Okay, last week was a big week for jobs. 3 different data points, and we are going to spend some time with the labor market because I have noticed a trend, and the more I pulled on that thread, the more evidence I found for that particular trend. And if the trend is true, it explains a lot of the data. So you'll see how this unfolds. ADP, the always wrong ADP, always wrong ADP. Everyone knows it's the always wrong ADP, yet it still moves markets. Came in at 497,000. And was it wrong? Yep. Yeah, the always wrong. It's been known as the always wrong ADP for years. Ever since I've been doing this, it was always called the always wrong ADP. Yet everyone calls it that, yet it still moves markets. I'm rather shocked at that. Initial claims came in at 248, and we had JOLTS, openings and quits. When you dig into the JOLTS, you start to see all the turnover that happens under the surface. So when we get the jobs report, the establishment data showed an increase of 209,000 jobs. We think, well, 209,000 were added. No, hires were 6.2 million. There's a lot of turnover under the surface. Hires were 6.2 million. Separations were 5.871 million. Of the separations, it breaks down into quits, layoffs, and retirements. So quits, people who just quit their job, 4 million out of the 5.8 million. Layoffs were 1.555, retirements 301,000, which is higher than what you would expect if you had normal retirements based on just the age distribution. And it has been higher than what you would expect for some time. So when you look at that, you think, okay, well, the pandemic probably accelerated quite a bit. But to understand what's going on now, we have to understand the nature of complex adaptive systems. And when I look at a bunch of companies' 10Qs for Q1, I keep seeing the same thing: voluntary retirement, voluntary retirement. So I start looking for evidence of that to see if it's showing up in more places, and lo and behold, it fits like a perfect piece of the puzzle. So we're going to dig into this. And why is this so high? It is higher than it should be. Let's go to the employment change household survey, establishment survey. They agree this time. Household survey 273,000, establishment plus 209. Participation rate 62.6 is unchanged, which would drop the unemployment rate because you have more people who have jobs but no extra people participating. 3.6. Down from 3.7. The unemployed dropped by 140,000. For the establishment, 209 employed. Goods producing sectors, 29,000. Services, 120. Government, 60. So all three are increasing. Look at the diffusion index. Let's just jump down there for a minute. Total. 58. Anything over 50 is expansion, right? 58 versus 61.2. This is for total. But if you just look at manufacturing, this is where you're going to get the goods. Manufacturing diffusion 56.3, up from 50.7. So is manufacturing rebounding? And if it is rebounding, one of the things the Fed has relied on for headline inflation coming down is the disinflation or the outright deflation in the goods producing sector. But if this is coming back, I don't know. Average hours 34.4 actually increased. So average hourly earnings and average weekly earnings. Average hourly earnings came in at 0.3586, annualized at 4.39%. My warning about average hourly earnings still holds. It is difficult to pull this apart because it doesn't just include the price, but the mix of jobs as well. And when you have excess retirements, it's going to skew the number that you see in average hourly earnings. It is going to understate wage inflation. And we saw that for Q1. Average hourly earnings kept coming in nice and everyone was celebrating it, but the ECI, the Employment Cost Index, came in at 4.8. Well, we're in July. At the end of this month, we're going to get another ECI. ECI is the true measure because it takes a job this month, and then it takes, or this quarter, and then next quarter looks at that exact same job and then measures the difference in pay as opposed to average hourly earnings, which includes the mix. And if you are having excess retirements, you are retiring higher cost employees and replacing them with lower cost employees. And even if that lower cost employee has significant wage inflation, it still is a lower cost for the company. So we got to be careful about this. Even with this, you're still at 4.39 annualized. Average weekly earnings. Now this is what's inflationary. Not so much the average hourly earnings, but average weekly earnings. Because remember, you give people money, they will go to the malls and spend it. So you can give them money in two ways. You can say, I'll give you more for every hour worked, or I'll let you work one extra hour. Either way, you'll go home with more money. 0.65 annualized, 8.1%. There's your inflationary number as far as demand-induced inflation is. You're sending people home with 8.1% on an annualized basis, 8% more money. And that doesn't get saved. That gets spent. The marginal propensity to consume is very high. And when you have rising home prices, which we've seen lately, housing prices on the rebound, when you have rising stock markets, you have a wealth effect. The marginal propensity to consume increases even more. Because consumers or households say, well, okay, no need to do this emergency saving anymore because the market's dropping and the value of our wealth is dropping. Our wealth is increasing again. We can spend more of our current period income because our future looks well taken care of with the value of our wealth increasing. So this is the real inflationary potential over here that I think you can't ignore. Lesson high school added 11,000. High school added 27,000. Lesson BA added 199. A BA or higher added 131. Full-time jobs up 382. Part-time down 262. There is nothing bearish in this jobs report at all. This all is a green light for the Fed to increase rates, and I think the number that they would probably be most concerned with is this over here, is how much money are we giving consumers to go home with. The aggregate potential demand is your average weekly earnings, not your average hourly earnings. You have to combine these two numbers together. And then if they peer down at the diffusion index for manufacturing and say, well, that's expanding again. We were counting on goods deflation to bring down inflation altogether, but if that is expanding again, is that going to put upward pressure on goods prices, or is it going to stop the deflation going on in goods prices, making the job even harder? I can't see how they wouldn't go 25 on this, but we get CPI on Wednesday, and that could change the odds altogether. Let's dive into this retirement issue here a bit. Okay, this is a labor force participation rate, 55 years and over, because this is pretty much where the excess retirements are happening. This is pre-pandemic. Over here, this is post-pandemic, and look what you have going on over here. This is your participation rate. Your participation rate is dropping. This is what I noticed. I was going through a bunch of 10Qs at random, just taking some companies because I was looking for, just initially I started looking for the difference between cash flow from operations and adjusted net income, just to see how many companies I could find that had the pattern of lower cash flow. It's almost every single one, really. There are very few that are increasing their cash flow. Earnings quality is deteriorating. But another thing caught my eye, so I started searching for it in other 10Qs, voluntary retirement charges, because I've seen these show up. And they range anywhere from 150 million to 10 million, 3 million, 20 million, 40 million, but I see them on here. And I remember GM had a couple quarters ago wanted to reduce their headcount, and they did it with voluntary retirement. Who wants early retirement? Here you go. Some of the banks I've been looking at have the same thing. So I started looking more and more, and it's quite common, these voluntary retirements. In Canada, Rogers and Shaw joined, and they're going to reduce headcount by, you guessed it, voluntary retirement. So I thought, well, these voluntary retirements are resulting in excess retirement above what you would normally see. That's got to be affecting the participation rate. So that's why I then pulled up this chart from Fred, and sure enough, there we go. So the pandemic did quite a bit, and then it started to sort of rebound, but then it continued back down again. And I thought, well, sometimes we don't know what's good for us until it happens to us. Then we say, who knew? And then you continue on. Is it possible, I thought, that companies experienced this excess retirement, and then realized, hey, you know what? That actually reduced our headcount and allowed us to keep our margins, because somebody who's been with us for 30 years might be making 150K, but if we replace them with a new person, we might be paying 80K for that, and we gain 70K in the middle without changing our headcount. Or if they just leave, we save 150. Now, normally we could get these people for 60, they're costing us 80, so that's huge employment cost index measurement over here, but for our margins, it ends up being very good. Who knew? Hey, let's do more of that, because I am seeing more of it. I'm seeing companies preserve their margins. I'm not seeing increase in initial claims, and I am seeing a drop in labor force participation rate for 55 and over. It fits the data. So, let's look at the idea of something that is complex and something that is adaptive, because to understand how economies work, we do have to understand this sort of thought. A complex system looks like this. The probability of A leading to B given Z. Z is some vector of conditions. That given certain conditions, the probability that A leads to B given certain conditions is some distribution. That we can describe some probability distribution of A leading to B if certain things are in place. Adaptive changes from probability to an expectation. The expectation that A leads to B given those very conditions changes behavior such that the probability either goes to 0 or 1. You no longer have a distribution. So, for example, if I say higher interest rates leads to a recession given certain factors over here, you will have companies that then say, well, if higher interest rates lead to a recession given certain factors, we should take steps now. And they adapt to that, and by adapting to it, they change they change their behavior such that it changes the probability distribution itself. So that's why when you're forecasting, and I see some forecasts that really just look at the complex part, saying, well, if you do this, this is the outcome, without taking into consideration the adaptive part that, yeah, but everybody knows if you do this, that's the outcome. They will then change their behavior such that the outcome either doesn't happen or absolutely happens. So when you have a system that gives you excess retirements that you would not have considered, and after you recognize that these excess retirements actually had a benefit, rather than waiting for it to happen, you may then actively go and get these excess retirements and promote these excess retirements rather than letting the economy promote them for you. So I thought, well, is there any further evidence of this? So you find a few little pieces and then you go looking further, and well, it turns out there was a Fed paper which comes to almost the same conclusions. Let's have a look at that. So this is the paper. The link is down in the description box. If you have the applied series, on Monday there will be a walkthrough of this paper, the methodology and the conclusions. It's called A Great Retirement Boom, the Pandemic Era Surge in Retirements and Implications for Future Labor Force Participation. Now, what they're doing here is the complex part. Is they're saying you had this particular backdrop and this is what happened. So A led to B given the situation that we had. And they only went that far that, well, this will fade away as the pandemic fades away and as the concerns fade away. And they have a regression where they use 3 variables. They don't have the 4th variable, which is the adaptive variable, is that, well, you do not consider in this paper the idea that companies will now also promote this, because that is now what I'm seeing. I'm seeing many more instances of voluntary retirement to lower headcount, and it makes sense. If I got a tight labor market and I need to reduce my headcount, I'm not going to eliminate the people I just hired because it took me forever to hire them. But I know in the next couple of years, there's going to be a group of people retiring and walking out the door. I wonder if I can get them to leave now. You see what I'm saying? I'm not going to release the people I just hired because it is a tight labor market. I have good people and I'm never going to find them again. They can get another job easily. I got people in the pipeline that are going to leave in the next couple of years, and I got a lower headcount. So I'll lower my headcount by getting some early retirement out the door. Not only that, the delta between what I pay those experienced workers and the newer workers will add to my bottom line right away. They don't consider that. And I find that to be the drawback. Yes, they have the complex part in there, but they don't have the adaptive part. There's nothing in the regression for the adaptation. And I think that there should be. Anyways, there's more discussion on this paper in the applied series. It will be in the market update folder. We're not done with this. Let's go to the screens. So let's look at 2 figures from that paper, just to show you the footprint that this is leaving. First one here, change in non-participation in the labor force as a percentage of the population age 16 and older, aggregate and by reason. So you have retirements, in school, caregiving, other, disabled, and not in labor force. And here's the pandemic, and then you can see the trends. You can see the total. This is the aggregate, has shifted downwards. This is non-participation. So non-participation is decreasing, which means participation is increasing. And for all of them, they seem to be trending down, except this blue guy. Retirements is actually trending up. Now we're in 2022. This goes all the way to October 2022. We're past the pandemic at that point, but they're still trending up. And they conclude that it's about 1.5% higher, because if you look over here, this is just a percent over here, 1.5% higher, accounting for about 3.5 million retirees. And this accounts for essentially all of the total shortfall in labor force participation rate. So from pre-pandemic to post-pandemic, the drop in the labor force participation rate, they conclude, can be essentially all accounted for by these retirements. Well, there are some people who are going to retire anyways, right? So they're going to leave the workforce. So what we want to measure is the excess retirements. It's kind of like saying, autonomous driving, AD, autonomous driving. You're still going to kill people. There's still people who are going to get in accidents, are going to get killed. This is not the right measurement. The measurement is how many people would have been killed in accidents without autonomous driving. And if the kill rate is lower than what would have happened, then we have surplus lives that were saved. So we have to look at an excess of what would have happened. This is not in labor force and retired, actual and expected. So they have this regression where they predict what the retirement rate would be, and you can see the volatile line is what actually happened. The dotted line is what was expected. And up to the pandemic point, this is 2020, it fit the data quite well. The hockey stick part of this chart is in 2010, the first wave of boomers hit 65. And this increased by about 0.2 per year, 15.5% up to 18% up to 2020. And then look at the gap. This is excess retirements, and they estimate it to be about 1.6 to 2.1 million. And their logic here with the expected is the retired share would have increased anyways. The trend line assumes the continuation of pre-pandemic age-specific trends. And you have to look at the methodology for Section 3. They do make some assumptions in what the economy would have looked like in the absence of the pandemic. And if you accept those conditions, then we can accept that this would have continued on that trajectory. I don't find their assumptions to be controversial. I read them and I say, okay, well, yeah, I can accept all those assumptions as being realistic. So this is the gap that we have, and they're bringing it down to 3 factors in their regression, as I said earlier. They're missing the 4th variable, which is the adaptive variable, is now that it's out there, it's not just the environment and the macro backdrop that can explain excess retirements. It is now the active participants in the economy that have to be used to explain it, which means now companies may start to use this to their advantage and not just be a recipient or a victim of excess retirements, but may actually be a proactive force in promoting excess retirements. When I was a PhD student, it wasn't enough to do some research and write a paper on something. Your advisor always says, so what? You'd pitch an idea for a paper. You'd say, well, there's this relationship that we can investigate. And his answer was, okay, let's say it's significant. So what? There has to be some kind of value to the outcome. So for what I just went through, so what? Okay, you have excess retirement. So what? Well, let's just see what implications that has here for the labor force. if you do have this promotion of excess retirements, we should see a lower participation rate than we do. Fred has given us the evidence that the participation rate on the 55 plus is significantly lower and dropping. Companies should realize a reduction in headcount without seeing layoffs increase, which means it would probably have very little effect on initial claims, and we have seen that. Initial claims have been fairly low. So what we should actually see are low participation rates, low initial claims, and low unemployment, which is what we do see. For companies, you have a lower employment cost per employee. The higher cost, longer tenured employee is out, a lower cost employee is in, even if wage inflation is elevated. It's just the delta between these two is a cost savings, even if you're overpaying for the employee coming in from what you normally would. So that would show up in the data as having an elevated employment cost index, but no effect on margins. When we do have elevated margins, they're between 11 and 12%. They've been elevated for some period of time, and Q1 margins, no real budge in that. But we saw that Q1 ECI was 4.8%. How can this be? Because the increase in revenues for the S&P 500 wasn't even that. So how can this be? Well, it must be some savings here. If you were getting this, you would be able to see an increased ECI with elevated margins, but you'd also see a hit to productivity. Because yes, you're getting rid of the higher cost, longer tenured employee, but they are going to be more productive because they know what they're doing. The lower cost new employee coming in is going to have to learn the job and develop the skill. And what are we seeing? Lower productivity. Consumption. Retirees spend more on services versus during employment. Typically after 45, goods purchases drop off. After 45 anyways, goods purchases drop off, but services don't pick up that much. But once you retire, services really pick up. Things like cruises, airline flights, hotels, resorts, a lot more stuff like that. So that sort of picks up. So what we would expect to see is services PMI in expansion, and if there is inflation in that area, core services inflation elevated, and a lot of demand for jobs in the service sector. We should expect to look at cruise ships, airlines, hotels, and see that they're doing very, very well, and well, they are. So it fits the data because you're taking 300,000 people a month. Now, they're not all excess. There should be about 150,000 retiring a month, but you're throwing another 150,000 onto that. So you have an extra, let's just say the extra 150,000 people a month that now are saying, okay, it's time to live. It's time to do well. Now, when you go through that paper, you will find that it is the more educated worker that is opting for early retirement. They're getting a buyout. They've already got lots of savings. They tend to be white collar and more educated, and they're saying, okay, this is great. Why would they do that? Well, we got to look at the effect of higher rates. Now, this is counterintuitive. It is possible that higher rates, that if we keep pushing rates higher, it will actually shrink the workforce even faster and promote more inflation. Crazy shit, right? Follow along. Think about a portfolio of MBS, agency MBS, investment grade, and the 30-year bond. You can construct a portfolio here that has somewhere between a 5 and 6% yield. So on a $2 million retirement portfolio, and for, if you think that's crazy money, for in the U.S., for a white-collar worker who has 30 years of employment history from 25 to 55, let's say, that is not unrealistic over the course of their life. That saving 10% of their income each year, or 15% of their income, which again, that's not unrealistic either, compounds over time. Well, take an average $2 million. With a 5 to 6% yield, just your portfolio now, and let's say you're 55, is providing 100,000 to 120,000. Go back to 2019. This same portfolio here on 2 million would have produced an income of 35,000 to 60,000. Now your portfolio is producing 100 to 120. So you get to a point where your portfolio is performing so well, you can lock in these rates right now. You can lock in a 30-year, you can lock in 15-year to 20-year investment grade debt. You can lock in mortgage-backed securities. You can pretty much lock that in right now. 80% of your portfolio there, 20% in the cash rate, which is earning 5.5%. You can pretty much immunize yourself on your income, on changes in income, by locking in those rates now, 100 to 120. Well, that changes your thinking about going into work the next day when there's an early retirement option with a buyout. And since you have a buyout, it's only going to add to this amount of money. You do the calculation, you know what, we're good. Thank you, central bank, for giving us these beautiful yields. We're good now. You push these yields even higher. You get another rate hike, and then another rate hike this year, another 50 basis points higher. Well, come on, you're 55, you're 60, your portfolio's performing that well. Higher rates could actually keep excess retirement rates higher, further increasing services demand and keeping participation rates low. So paradoxically, the Fed is raising rates to get more slack in the labor market, but those higher rates make it more likely that I'm going to retire early, thereby decreasing the participation rate and keeping the labor market tight, precisely because you're doing this. Now, if this is a thing, and companies are starting to use this, saying, look, labor market is tight, so let's push more of these people towards retirement early, then you're not going to get out of this situation very easily. Because the higher you push rates, the more attractive it becomes to retire early. The lower the participation rate gets, the tighter the job market gets. And as you push these people out the door, if they're locking in these yields, they are interest rate insensitive at that point, and they're going to do what retirees do. Spend most of their income on services. They're not buying goods anymore. They're not replacing their furniture. They're not redoing their kitchens and their bathrooms. That stuff is already done. They are traveling. They are going to concerts. They are going to symphonies. They are going to plays. They are going on train rides, bus rides, plane rides, hotels, resorts, cruises. They're doing that kind of stuff. And they have pretty much a government income. Because if they're in the 30-year, let's say, that is what the government is paying. You could put it all in the 30-year and you're at 4%. So on $2 million, you're still at $80,000 a year, and you've locked in 30 years of $80,000 a year at 4%. It just fits the data really well that if you think, okay, well, take these excess retirements, what would I expect to see? And I do see what I would expect to see, and the implication is if you raise rates even higher, I would look for even more early retirements or excess retirements. One of the things I think that we should look for in Q2, I said that there would be layoffs announced. That's one of the things that I'm expecting to see is more reduction in headcounts across all companies. I'm going to modify that a bit and say, it would not surprise me to see a lot more of the reduction in headcount coming from voluntary retirements. And if they are coming from voluntary retirements, that services inflation is going to be sticky for a long time, and the participation rate is going to be low for a long time, which means the Fed has got a tough job. It has no choice at that point, no choice but to actually break the economy. It has no choice. Because it's not going to get that down, because the higher it inches rates up, the faster it encourages early retirement. And then it inches rates up a little bit more to cut down inflation and encourages more of that kind of stuff. No, you must break it now or lower rates all the way to zero. If you lower rates all the way to zero, well, then suddenly early retirement is not that attractive because your portfolio is not going to earn that money anymore. Well, you can't do that either. But paradoxically, if it is excess retirements that is causing most of this, because it fits the data quite well, then the unobvious thing to do would be to lower rates all the way to zero. This is like running into the fire. In 1986, I worked in Canada for the Ministry of Natural Resources, and I was on a fire called Red Lake 7. Red Lake 7. You can Google that and see when that was. I was a forest fire, or what's called an RT1, Resource Technician 1. And you have training to do this kind of stuff, and one of the things that they teach you is how to avoid being burned alive. When a wall of fire is advancing on you, you're not going to outrun that fire. That the safest thing that you can do is run into the fire, because on the other side of it, it's burnt. Now, if it's a big wall of fire, there's really not much you can do, but fire doesn't always burn in a big wall. That there are spots through the trees that you can run. So they tell you, run into the fire. Don't run away from it, run into the fire. It's your best way to survive. Well, maybe the Fed needs to run into the fire. Maybe the answer is not higher rates. Maybe higher rates is like a big echo. You know, the higher you go, the bigger the echo. Maybe what you need to do is run all the way back to the zero line and crush the retirement hopes of this group of people so that they stay in the workforce, and the participation rate then starts to inch up. Because the Fed paper said that the excess retirements basically account for all of the drop in the participation rate. Maybe we've got our solution. Let's bring rates down to zero. Let's crush the hopes of this group of people here. Okay, let's look at SPY. Our 4-quarter forward operating earnings sitting at 220.93. The closing SPX was just a little under 4,400. Gives it a 19.91 times forward earnings multiple. Last week was 20.03, so sitting right around 20 times forward earnings. On an as-reported basis, not just operating earnings, but GAAP basis, 203.05 is the estimate, which puts it at almost 22 times forward earnings, 21.66. Again, against the macro backdrop that we have, rising rates and shrinking money supply, almost 22 times a forward earning there. Implied volatility is back. The 13-week percentile is the 35th percentile, up from 0. So it's up on all measures. We got a big risk week this week. You have Fed speak all week, Monday, Tuesday, quite a few people. Wednesday, CPI. Thursday, PPI. Friday, you have the banks. And here are the earnings for next week. If you go to Friday before the market opens, you have BlackRock, Citigroup, JP Morgan, State Street, Wells Fargo, quite a few. And you have some companies that are Thursday before the bell, ConAgra. You have Delta, I'm sure they'll do well, Fastenal, PepsiCo, and some insurance there, Progressive. Week to week, as I do my analysis, I become more and more convinced that I just can't see how we can actually get these multiples, that earnings will come in, that we're going to get this kind of growth against the backdrop that is actively trying to push growth down. And the Fed, I believe, will have no choice but to continue to raise rates. That I think in a couple of months we may be talking about 6%. Maybe by the beginning of next year, if nothing breaks and we continue on, we might be thinking 6.5% or 7%. So I think they're going, unless something breaks, rates are going to be higher and higher for longer. And I don't think the equity market has priced that in yet. So I will continue to add to my short ES position on any rally to 4,500. That is the September ES at 4,500. And as it moves up, let's say, you get to 44.70, 44.80. I'll go out 2 days. I use the options 2 days to expiration. I'll sell the 4,500 calls. I'm not going to wait for it to get to 4,500. I'll sell the calls. If it exceeds 4,500, my short position will be 4,500 plus the premium. So I will sell 2 day to expiration calls, because there is some premium in the options now, so I'll take them while they're there. If they don't get to 4,500, hey, I get all that premium for free. If they get to 45, I get a higher short position. I don't know if we get to 45. I really don't know. But we don't have earnings till later in the week. We have Fed speak Monday and Tuesday. I think we'll find that we have a divided Fed, or divisions in the Fed are showing up. I think we'll see that. Which division the market wants to pay attention to, I don't know. And everything happens here. Wednesday at 8:30, Wednesday CPI. I don't know that there's going to be much excitement Monday and Tuesday. Now that I say that, there'll be lots of excitement Monday and Tuesday. And now that I've said that, there'll be no excitement Monday and Tuesday. I don't know what to expect, but I'm ready. I know what I want to buy on any significant sell-off, and I know what I want to sell on any significant rally. So all I have to do is wait for the market to give it to me. Now that I've said that, it's going to go sideways. There's no winning. I can't let the universe know what I want because it gives me the opposite of what I want. I don't want to win a $50 million lottery. Dear God, I don't want to win that. Let's have a look at the economic calendar. Okay, beginning Monday. There's not much here I haven't pointed out. You'll notice a lot of Fed speak during the course of the week. We have actually 3 o'clock on Monday, consumer credit change, backwards looking, but that is for May. Getting into Wednesday, there's your big risk factor there in the US, your core inflation rate, and in Canada, 10 o'clock, Bank of Canada interest rate decision. Don't get too excited because at 11 o'clock, Meldrum comes out and says what he says. The expectation here is for a rate increase. I don't think we get one. I'm sort of against the consensus here. I don't think we get one. If we look at, rather than running through it, the core inflation rate, the forecast is for 5, down from 5.3. If you get like a 4.9 or a 4.8, it's off to the races for the market, and the bond market will rally. So my TLT, my sold TLT puts and ZB puts will do very, very well. If this comes in at 5.3, 5.4, 5.5, then no, not so well. But my short position on the market should work out. Going into the afternoon, there's the WASDE report. If you're following the grains, be careful about that. It says low impact, low for the market, but it is a high impact report for the grains. And you have the Fed beige book at 2 o'clock. There's PPI the very next day in the US. Not much going on that day, and the only risk factor, well, it doesn't show. You have lots of risk Friday morning with the banks reporting, and then at 10 o'clock you have Michigan consumer sentiment, which I don't know if it will matter based on what the bank's earnings are. That will pretty much, I think, dictate the day of what they say in the morning. And that's it.